each Friday that we have the show, I try to do a summary for what I saw happening in the stock market this week. And we've been working with this particular chart for quite some time. Kind of goes back to 2018, and I keep that in there because that was the first dip right at the beginning of this chart. I think it was 19.6% from high to low. That was around the tariff time. That was the first term for Trump, for example. And lots going on here. It's kind of incredible, right? We had the big pandemic drop and all these things, and yet the market is still up quite a bit from 2018. That's for sure. This week, it looks like market might be down. Today's kind of rallying back as we go. I think I saw a negative 1.2% at one point in time, and was less than 0.2% down the last time I looked just before the show started. So we'll keep you up to date on that. But um, we've not had a lot of negative weeks. As a matter of fact, they were talking about this week possibly being really the most negative it's been since April during
Mhm.
the Liberation Day downturn. So let's talk about why that is. Seemed like things were going along normally, and then I believe it was on Tuesday, the CEO for Goldman Sachs, the CEO for Morgan Stanley came out and said, the market's overvalued. We're expecting a drop, and then we're talking more like that 10% type drop, just to take the heat off. I'm all favor for those. I mean, if you look back just over my shoulder there's a drop that happened in the summer of 2023 that really, once that was over, catapulted the market upward, in a very fast fashion. When you get these, I always talk about the rubber band, right? So, market's going up and up and up. You're stretching the rubber band. There's more and more resistance to that. So when you get really stretched out, you're going to have more of a snap back. If you don't stretch it that much, sometimes the snapbacks are less, right? For the same thing, you can go the other way. It can go down too much and then snap up, right? And so you're watching for those. There's actually different measures for those. Wilder's RSI is one way of looking at that stretch and such too. So when we look at this particular market, it has unbelievable momentum to the upside. There's no doubt about that. We're still in a primary direction up. We have been setting higher lows all the way through this uh, period since the bottom of the Liberation Day, situation that happened this year in April. And we've had, very small pullbacks all the way through. We're still trading above the 50-day moving average. We're still trading above the 200-day moving average. The 50-day moving average is still above the 200-day moving average by quite a bit. So these are things that we look at and say, okay, the rally is still on until proven otherwise. And so uh, we very much so would think a drop of some type here is actually healthy. I'd rather see, that lessening the tension on the rubber band, so to speak, so that we might not have as big a downturn at some point in time. And you can maybe continue to go up at a more steady pace, maybe farther than you do when you stretch the rubber band that much. Because what happens when you stretch the rubber band, basically you're stretching valuations. And all of a sudden you could get a situation where a lot of people start to contribute to the downside and trying to get out. And then pretty soon everybody else is seeing that, and you could get a snowball effect. And that's what always bothers me about these markets that pull up a lot is that snowball effect to the downside versus one that's more steady. You don't get as much of that snowball to the downside. So uh, I wouldn't be I wouldn't be surprised to see a pullback here just because we did have such a great September and October altogether. And September is, going back to 1928 is an average negative month. It's the only one. And so we had a really good month. Matter of fact, that was true last year also. Both times we had rate cuts. So I think it sort of artificially pushed the market up. Um, and just my gut feel, just from my experience, I don't have data to back this, but when we have a really good September and November, or October, November can be a little bit weaker, and November is the best month of the year historically, right? So we do have seasonality on our side, yet we're looking at negatives. Okay, it's still early. We're not done with the month as far as that goes. But um, so one of so that was the first portion that seemed to get things going was the CEOs talking about the downturn. And there's a lot of respect for what these especially big bank CEOs say because of their access to everything, to, commercial credit, to private credit, to home loans, to car loans, to and they're seeing, hey, what's happening here? We can see consumer behavior. They have credit card data that they see. I mean, this is a group that, Jamie Dimon's another one, right? You kind of want to pay attention to what they're talking about. And I'm not surprised at all that the market didn't respect what they were saying and kind of have some softness this week at least. Um, and then the next thing that happened, we don't have the government reports coming out like we used to because the government's closed, but we do have some other reports. So the ADP report came out, which is the ADP is a payroll company, and they actually said there was 42,000 new jobs created for last month, and uh, that was a lot better than the previous 2 months where it was actually negative. Yeah, and it was above expectations. So the market actually stabilized on that day and did well, but then I think that was Wednesday, and then Thursday, we get this report saying that there was 153,000 people laid off in October, and that's the highest we've had in 20 years. Yeah, and so now we're in the market was responding to that. Generally speaking, the market has responded positively so far to negative situations within the labor market because it means that they might be lowering interest rates, right? But there is a point in time, especially with that number, when you get 20 years worth of data, and this is the highest layoff month we've had in that 20-year period, the market's going to look at that maybe as a negative in this particular case because it's big enough. So let's talk about why that happened. And I'll switch back to here just so we can chat for a second. If you look at the layoffs, what you're hearing a lot about is like AI.
Mhm.
Oh, and people that got AI and people aren't getting a job. Um, just from what I've been reading and the different things that I've watched, uh, most of the people out there who know what they're talking about are saying that AI isn't at a spot where it could create 153,000 job loss, right?
Mm.
It's just not far enough advanced to be able to do those things. But there are two potential, depending on who you listen to, reasons that are farther than that. One is AI related, and that is that these companies are spending massive amounts of money trying to build out their AI infrastructure, whether that's a data center or software enhancements or whatever it is. But they're public companies, so they still have to produce higher earnings and meet expectations for those earnings. And so they're cutting costs.
Yeah, Meta is a good example of
Yeah.
that, where Meta, was hit for their earnings being lower than expected because of how much they were spending on AI.
Yeah, so that's kinda I think that's kinda reverberated actually through this week because that was last week, and so it's reverberated through where it's like, "Oh, these companies are spending a lot on AI, it could be affecting their earnings because there is no revenue from
Mhm.
that AI, it's all spend, which is very similar to what happened with the internet, everybody had to buy infrastructure and do all these things, and even data centers and cloud computing kinda eventually came out of that too.
Yeah, with a lot of the social media companies, it was all about, it didn't really matter how much they were spending as long as they were getting eyes or users on the product
That's right.
eventually before they had revenue.
Yeah, because Facebook didn't have revenue or well, they didn't have earnings, and until later, and the revenue was fairly small compared to the price, and it was just about how many eyeballs you could get, yeah, so, um, so the spend on AI is causing some of these layoffs. There is some productivity enhancements that they were talking about, but it's not that great, but the people that are there are able to do more, and so there's been kind of a freeze across the board. They call it a low hire, low fire environment. And so we're not seeing, tons of firing going on until October, in my opinion. But we're not seeing a lot of hiring happening either. You look at the different reports, again, private reports from companies like Indeed. So Indeed is doing kind of the report, what we call the JOLTS report, which is the big jobs report that comes from the government, which would have come already. Matter of fact, I think it would have come today, I believe. Anyway,
Yeah, likely would be to.
and it's not here. So we're looking at these other reports and it's showing, some decreasing in, job applications, sorry, job postings as far as that goes. So the other area is tariffs. For those companies that are exposed to tariffs, again, they're trying not to pass along all of the cost of the tariffs to the consumer. I think more and more we'll see more and more of the cost move to the consumer. That's what's been expected, and that's what's already is happening. However, again, still trying to make the earnings. They're also cutting back in their costs because now they got a new cost,
Mm.
this tariff, and we can't, and one of the areas they're cutting back in is the area of labor. So kind of the combination of Some replacement. There has been some replacement of AI. If you're in a call center and in different places, there has been some direct replacement, but there's some of that. There's some of the spend on AI and then the spend on tariffs. All of those are kind of coming together to create a situation where you're getting a much higher layoff picture.
Yeah, they're making workers that are still employed are more productive, and so they're able to do more basically. So you're able to do more with less.
Right, right. So it's interesting, and we'll see how that continues, right? Because that probably just the beginning of that as far as that goes, and we'll see how that plays out. And so I have an interesting analogy that I've been working on this week that I'll kind of share with you. So basically, let's pretend that water is coming into the economy. And if there's more water coming in that can drain out, the economy is going to grow, stock market's going to grow, right? And it doesn't have to even be the economy. It could just be the excitement about, what is happening. And so the water that's coming in, and I'm using a fire hose here because it's coming in at a really high rate, is the money that's coming in that's being spent on AI, specifically the data center build outs. But there's going to be all kinds of different things that are pieces in that. And so that is essentially now we look at like a drain, okay? So if the drain is all the things that is gonna suck the water out of the stock market, suck the water out of the economy. So if you have more water coming in than the drain can handle, the stock market's gonna go up,
Hmm.
right? So here's rough example, kind of a drain that's being overwhelmed by water that's coming in. And so let's say the drain is all of the things that we're worrying about, okay? Tariffs, deportations, independence of the Fed, the government shutdown, and, all of these different pieces that are just keep piling up, right? And so right now, the drain and all those things we're worrying about isn't enough to take all the water out of the economy and the stock market because of the fire hose that's coming in, right? From this data center and AI build spend. It is the biggest thing by far. Without that, the economic growth is essentially zero in the first half, right?
Hmm.
And so that's the analogy. And so here's what you want to watch for. If the AI spend starts to drop down, like if you had a garden hose instead of a fire hose of AI spend coming, now the drain is sucking all of the water, right? All of these things that we were worried about, even if they don't get bigger, can still drain the water out of the economy, and we could end up with a stock market that comes down, more than the 10% that the CEOs are talking about. And so really, the other aspect of that, if we go back to this drain here that's being overwhelmed, is the drain just grows. Even with the fire hose coming in, tariffs could knock it out, theoretically, right? Historically, tariffs have been really hard to deal with over the long term. It's why they don't stay up there very, very often or ever, really, or at least since the 1913s when they started doing income tax, because it is a tax. Matter of fact, they basically hammered that home. The Supreme Court, case that happened today, which we'll talk about for a second, but they're convinced the administration is trying to say it's not a tax, but the Supreme Court, they don't believe that.
Yeah.
Yeah, I don't either. and so and so if you look at it, we have two taxes. We have a federal tax and we have a tariff tax. And prior to 1913, we just had the tariff tax. Yeah. And so tariffs were higher back then. But since 1913, this is the second highest tariffs we've had, and the others were 1930. But we're very, very close to 1930 levels. And so you could see a situation where even if the fire hose of data center stuff comes in, the whole, the tariffs, the deportations, the independence of Fed, the government shutdown, all of these things just start to build up, and they create a drain that can handle and take the economy out of the stock market. And so that's what we're watching for. We're watching to see, does the AI build out start to moderate. That is a little bit about what has been talking about this week in this downturn. There's some worry about it. Everybody's worried about the fact that none of the AI people are making any money off of AI per se. I mean, there's some productivity gains. I guess you could say that's making some money. But a lot of the projects are still struggling. We'll see how that plays out. But really, it's still, as long as the money is flowing out from these companies and from these, from every corner of the world really is really
Mhm.
driving into these things because people can see the potential opportunity, whether that opportunity comes or not. So I think that's pretty fascinating. That's a good way to look at it. Does the fire hose continue? Uh-oh, sorry. Does the fire continue, or does the, fire hose continue, or does it drop down? That would drop the market, right? Does the drain, the things that we're worried about, do they get big enough? They're not big enough yet. They're mostly because they're probably delayed. And maybe they don't get big enough. Honestly, AI spending could become two fire hoses for all we know, right? It could continue to grow even faster. We'll see what happens. But I think that's a good analogy. Now, there was a case where the Supreme Court heard arguments on Wednesday. I listened to most of that, and very interesting. And I was a little bit fascinated because there has been a lot of information coming out of the Supreme Court backing the current administration. This doesn't look like it, at least at the moment. They haven't decided yet, but there were 6 of the 9 people really asking, I thought, questions that led me to think that they were going to vote against this. And what they're looking at is whether or not these tariffs are legal. They are looking at them in the sense of taxation is handled by Congress. This is a tax, and the president shouldn't be able to do taxation. Specifically, the founding fathers didn't want the king to be able to unilaterally decide on tax, which is what the problem was. That's what the Tea Party was about to a large degree. And so that's their main argument. Now, the problem is that um, they're not looking at the other part of the argument, at least so far, where they're looking at this. It's supposed to be for emergencies. And so, honestly, if you look at the administration, I think they're kind of fudging it a little bit on what's an emergency. Yeah. And so they're not going after it in that regards. And the problem there is because of these other tariffs that are allowed, they also revolve a lot around the emergency concept. So, for example, the line item tariffs, where you can go for steel and aluminum and such, and so the president has that ability to actually set up a tariff. So that's allowed. That's a problem with the current piece that they're using now. It doesn't actually say anything about doing tariffs. It says regulate, not do tariffs. But they do have others that allow the president to do direct tariffs, but again, it's sort of on an emergency basis. So steel, aluminum, pharmaceuticals, semiconductors, they're going to try to say that everything's at an emergency, maybe because of trade deficits or whatever it might be. And so if the Federal Reserve if the Supreme Court does not rule on this particular one on an emergency basis also, not just the fact that it's not tariffs, but the fact that it's also not an emergency, right? You can't say Brazil should have a 50% tariff higher than the other countries that are around because you don't like the fact that they're prosecuting a previous president. That's not an emergency, right? So um, I would prefer if they actually address the emergency portion also, because that would help on these other cases, because likely we'll end up in the same spot again on these line item tariffs where they can do, because what is the emergency for that as far as that goes? And so, because it's supposed to be, it's an emergency to protect a particular industry,
Yeah.
right? So if you're going to line item tariff, semiconductors, well, we are the industry. We're the ones that everybody in the world's worried about. If you're going to line item steel, okay, yeah, maybe, because we have a harder time making steel at a competitive price compared to the rest of the world,
Yeah,
right?
they've done it back in the 2019
Yeah,
with
right.
washers.
But it would be more limited in theory,
Mm,
right? Than what is probably going to roll out, which is they're going to try to tariff every single line item they can find, right? To try to get back to this 18 to 20% kind of net tariff
mm,
situation, because so the net result is if they take this away, all of these tariffs that we've been talking about, 80% of them. I mean, the China tariff, the negotiation that they've had to finally they've reduced tariffs, last week and what have you. It goes to zero, essentially, except for the line item
mm,
things. So anything that was done under the emergency piece, that wasn't a line item piece would disappear. And depending on what the Supreme Court does, do they require a refund, right? Uh, Historically, that's what's happened. There was a refund plus interest. Now, don't expect any of that money anytime soon, because apparently the last time they did this, and it was much, much smaller, it took a couple of years
mm.
to get it back. However, uh, that's going to be very fascinating to see how the market responds. Because on one hand, just disappearing tariffs, you just got rid of a tax. companies are making more money, right? Theoretically, prices could come down, all right, because they've been increased but because of the tariff. And so that could be great for the stock market. On the other hand, if you have to refund all this money, the bond market is where they're going to have to go because it's not sitting on the
Yeah,
sidelines
we've
with
already
this
spent
money.
this money
Yeah.
essentially.
Well, we should have because we're running a deficit, right? So, and so that's going to affect the bond market because you have to issue these bonds. Maybe it won't if they do it over 3, 5 years, who knows, right? So anyway, these are unprecedented situations. We haven't had a Supreme Court ruling like this before. We haven't had actually, Donald Trump's the only one who's ever used, this particular emergency declaration, and applied tariffs. He did it in 2018, and he did it now, and he's the only president and this thing originally came into play in 1970. So, um, the betting market, right, which is the place to go if you want to see what the results might be, because polls and other things don't seem to be as accurate as the betting market. I think because when you put your money down betting one way or another, that's a lot more conviction than answering a question in a poll, right? So it was the betting market was more accurate on predicting who the next president was than the polls. And so the betting market right now dropped down to 25% chance that these tariffs stay. 75% chance that they go away. So I think that's a really what a week, really. All these things that are happening, and this is you know, unfortunately, every week's kind of like this,
Mhm.
right? It's incredible. Lots to talk about. So anyway, that's our outlook. Watch for the fire hose. Watch the drain. Don't just think that because the drain's there that everything's going to fall apart. If the water coming in is higher than the drain can handle, the stock market's going to go up, and that is what is happening right now, right? So the fire hose of money being spent on these data centers is outweighing any of the other concerns that the market might have now. That can change, but that's how you watch it as far as that goes, as far as we're concerned. And so, right now is the time to kind of be in there. We still have money out. Main reason being because when this thing snaps, it could snap quite quickly. And it might not snap, but if it does, it probably is going to be pretty quick because you'll start to get some real fear. I mean, we're even seeing it in the cryptocurrency market. I think most of the gains that came from 2025 have disappeared. And that's a market that moves a lot faster, and the stock market may follow that whole concept also. So anyway, that's what's happening today. Thank you for joining us for our summary as far as that goes. Look forward to being able to do this again, summary again next week too.